Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I am Mike Wallberg, and I have a listener alert. You may learn the secret to picking 100-baggers today. Joining me today is Neeraj Khemlani, former president of CBS News and author of the book, The Coffee Can Investor, a stock picker's journey to build generational wealth. In it, Khemlani blends rigorous research with storytelling, drawing on decades of exposure to corporate leaders, innovators, and investors. Through his collaboration with portfolio manager Matt Ankrum, who's also with us today, he translates complex investment principles into accessible insights about compounding, business quality, and generational wealth. Matt Ankrum, CFA, is a managing partner of Ankrum Capital and an adjunct professor of finance at University of Missouri, Kansas City, and I'm grateful to have them both with us today. Welcome to the show, guys.
Thanks, Mike.
Thanks for having us.
So, Neeraj, I'll start with you. Your journalism roots were clearly showing in this book, as you started with a hook that really instantly brought me in. And I'm not talking about the stats and the investing surprises that Matt's research uncovered. You started with family, with Matt's 3 daughters. And for me, that really resonated instantly because I have a teenage daughter who I've been talking to about compounding since she was about 6. I wonder if you could start us off by just talking about your long association with Matt and how family really anchored this book.
Absolutely. I've had the privilege of knowing Matt for over a quarter century. I met him when he was a, portfolio manager and analyst at Janus, in the late 90s, when mutual fund companies like Janus and Invesco were the high flyers and, the internet was launching. And my wife was a reporter in Denver, and I met Matt at a party, and I just thought he was one of the smartest people I had talked to in a long time. But more importantly, I also thought he was one of the kindest people I'd ever met. And a large part of that was he could make me understand high finance. Don't test me on that during this conversation, but he could boil down really big concepts and he became a source of mine over 2 decades where I would talk to him about all things Wall Street, corporate America, and it helped me sort of navigate coverage, business news coverage in newsrooms that I've been privileged to be a part of. And I got to know his family along the way. His wife, Mallory, his 3 daughters, Peyton, Morgan, and Pierce. And they have a value set that I really respected in terms of how they thought about the world, how they thought about education, and how they thought about investing. And so I always, commingled what I was learning from Matt, but also getting close to his family. And that was the genesis, was our strong relationship for these catch-up calls every year. And if I may, I'd love to just tell you the call that we had that was the genesis for the book. Um, yeah, so Matt, a couple of years ago, when I talked to Matt to ask him what he was up to, um, what's kind of fun about Matt is that he reads all of this really arcane financial literature. And he was reading an article in the Journal of Portfolio Management, which is quite the wonk, journal. Does the Quant of the Year award, and so he's telling me a story, and it's called Coffee Can Investing, and it's a story about a stock picker working for Capital Research named Robert Kirby, very conservative guy who, worked for Ronald Reagan after the stock market crash in the mid 80s. And he was managing people's money and he approached a woman in Los Angeles, an heiress, about managing her money. And she said, "Look, I like you, and yes, you can manage my money. I don't know a lot about this kind of stuff, but why don't you deal with my husband on day-to-day matters? He's a lawyer." And so he said, "Fine." And over the years, Kirby would call up the husband and say, "Buy this stock for your wife." And the husband would dutifully buy the stock for the wife, but without telling anybody. He would buy the same stock for himself okay, with his own money. So he wasn't doing anything wrong and put it away. And over the years, Kirby would call the husband and say, okay, it's time to sell this stock for your wife. And he would dutifully sell it for his wife, but he didn't sell it for himself. In fact, he kept all his stock certificates in a coffee can for safekeeping for the long term. And this goes on for a very long time. And the husband passes. And this coffee can full of stock certificates, back in the day when you had stock certificates, was discovered by the wife. She looks at it, doesn't know what this is all about, and gives it to Kirby. And Kirby looks at it and in a hot minute says, I know exactly what's going on. The husband had been piggybacking off of all the buy recommendations, but never selling. And guess what? His portfolio did far better than his wife's. He would buy $5,000 of each stock recommendation, and some of them trended down to 3,000. A bunch went to 100,000, and one went to 800,000 for, over 100x return. And Matt tells me this story, and I'm reading the article, and at the end of the article, it says, I hope that someday someone somewhere will repeat that experiment. And that person is my friend Matt Ankrum. And he was particularly interested not only in the long-term investing attributes of the coffee can, but he was wildly fascinated by stocks that could multiply 100 times. And it was that story that made me start pursuing the idea of doing a book about Matt and what he was doing.
Amazing. And so Matt, thank you again for coming on the show today. How far into the experiment are you at this point?
So I am not filled it out completely yet, but I am well on the way. And one of the things that we talk about in the book is we do give 13 companies that are in the coffee can. And so looking to build this out, we talk in the book about 10 to 20 names, and I'm looking to kind of get to that 20 over time. And so what Neeraj laid out was once this kind of idea of a coffee can came into it, as he talked about, then it's like, what do you put into the coffee can? And that's where I started looking and, my fascination grew on this 100 baggers. And so there's a couple books out there. There's Thomas Phelps' book, 100 to 1, and then Christopher Myers' books, 100 Bagger. Great books, really laid out, some really interesting facts about it. What I was actually looking to do, though, called as Neeraj talked about, kind of the wonk in me, was that I wanted to actually go in and say, is there any quantifiable attributes about these companies that would help me better understand and predict what maybe the next 100 bagger might be. And so I started out started down this path. And through the study, I was looking at it and I'm like, I figured it'd take me a couple weeks. I can pull all the data, see what there is. And it ended up taking me almost 6 months to finalize. And over that time frame, I, was able to go through and not just do the quantitative part about it and looking at what the numbers told you and kind of what it looked like, but I was able to get into the qualitative. And so let me just walk through a little bit on how that study, kind of played out. Is the
Yeah, I'd
first
love
thing,
love to hear what those factors are.
yeah, yeah. And so the first thing that I did, just so for your audience, is I went and said, I need to get all of the data. And what I needed to do is I wanted to cap it at 30 years for them to achieve the 100 bagger status. And the reason why I wanted that was because that enabled a company to basically increase in value about double what the stock market would do. So these to me would tell me that these are exceptional companies and that, there's something about them that made them, very unique. So it did that. The second thing is that I had to actually start from 1980. I couldn't go back further because there wasn't enough easily identifiable information at that time. And then I capped it at 2000. So I looked at all companies that went public from 1980 to 2000, and that increased in value by that hundredfold. And here's the characteristics that came out of it. I'll give you, there's a lot more in the book, but let me just give you 3 quantitative and 3 qualitative. So on the quantitative side, and this shouldn't surprise anybody, but quality was paramount. Said differently, is that a bad business will never make an exceptional stock over the long run. They just can. And so that was the first one. The second was that growth mattered. And what I meant by that is that just because you have a high quality company, if it doesn't grow, it can't compound. And so in this study, the average growth rate over the first 20 years was about 20% a year.
That's in revenue, right?
Yeah, in revenue,
Right.
exactly. And so that was the big driver on that compounding effect that they had. And then the third characteristic was that these companies were not just satisfied with doing the status quo, they actually showed continuous improvement. And so the median improvement in the margin was 25 basis points or 0.25%. Now, that doesn't sound like a lot, but over a 20-year period, that's a 500 basis points or 5 percentage point improvement in that margin. And those small, imperceptible changes in the short term actually derive true insurmountable advantage over the long term. Now, on the qualitative side, the big aha moment for me, and I think Neeraj caught this right away when he and I were talking about it, is that 68% of the companies in the study were B2B companies.
Yeah, that was the big surprise for me as well. That was crazy.
Exactly.
Because you look at today, the big darlings are like Apple, and investors out there think these are where you make all your money, but it wasn't. It was the boring stuff, right?
That's exactly right. So, if you think about it, the average investor, when they think about great stocks, they think about the Apple, the Starbucks, the Nikes, and all of them were actually in the study. But it was the other, kind of non-sexy, kind of less interesting story, maybe from a retail perspective, that truly generated the majority of the 100-bagger returns. These are companies like Fastenal, that does industrial distribution of fasteners and bolts, or a Cintas, which is just a uniform rental company. So these were companies that compounded year in, year out and drove that. The second big takeaway was that 76% of the companies in the study had recurring and repeatable revenue. Now, why is that important? Well, if you're a company manager, one of the things that's great about it is January 1st, you actually already have revenue booked. So what it allows you to do is spend your time building on that, so focusing on growing that, but also it gives you a lot more flexibility to invest in the future. So you knew that you could spend on R&D or that you could go out and build new partnerships or whatever it might take to invest in that. And then the third takeaway, and this being a young analyst surprised me the most, 82% of the companies in the study were serial acquirers. Now, these were not kind of the big mega mergers, the, kind of bet the farm type of acquisitions like Time Warner and AOL. They were more the typical kind of bolt-on acquisitions that you have. And what the companies were really doing, if you looked into it more, was they were accelerating their roadmap. And that could either be their R&D roadmap or it could be the strategic, kind of expansion roadmap. But they were spending money to build out the capabilities to help them achieve the long term. So there's a number of other characteristics that we found that's in the book, but I'll leave it to stop there, just thinking that those are probably the most interesting.
Well, I gotta tell you, when Matt was dealing these headlines, like, a blackjack dealer just throwing aces at me at the table, I couldn't walk away from them because, it really merged with what I was seeing inside of Hearst, which is, a global media company. And when I was there for a large part of my tenure there, I was overseeing the cable network partnership with Disney, channels like ESPN, the History Channel, Lifetime, etc., A&E. And those were always the biggest contributors of profits to the Hearst Corporation. But in my tenure there, those are B2C companies, right? But in my tenure there, I watched our CEO on a capital allocation business authorize acquisitions, which was, the second piece of what Matt just said, of B2B companies, B2B media companies, right? Data and information companies that were providing information to companies that, consumers don't really pay a lot of attention to. And the largest company in terms of profit contribution last year at Hearst was Fitch. the bond ratings agency, a B2B company. And so when Matt's, sending me these cards of his insights, what I was seeing in a private media company, he was seeing in the public markets, right? And so I'm sitting there, I'm like, what do I do with all of this information? It's just really useful to a lot of the, investors out there. But then Matt took it up another notch, and he took all of his findings of these 100-bagger companies and said, "You know what I'm going to do? I'm going to use that research and those clues to hunt for what he thinks are future 100-baggers," right? And, you know, get, 20 stocks or so and put 250,000, dollars into each one, into a coffee can for his 3 incredible daughters. And in 30 years, if everything hits, that 5 million could be a $500 million coffee can. And when I understood that math, okay, and that's math that I can understand, you don't need a CFA for it. I said to Matt, that's a book. We got to tell your story. We have to share your research as well as your relationship with your daughters. And so the book is very much inspired by Rich Dad Poor Dad, as well as Jim Collins' Good to Great and the proprietary research that Matt generated.
So Matt, I'm curious about that because I'm sure many listeners hear steady revenue growth, margin expansion, return on invested capital, wide moats, and they think, yeah, I look for those things too. So tell me a bit about your process for picking stocks. How did you reverse engineer those 100-baggers? So how do you distinguish between a good company and a great compounding machine in your actual process?
Yeah, so think about one of the most difficult things to be as an investor is patient. And the challenge is that, and I just saw Warren Buffett from an old interview was talking about this, is people went to him and said, wait a minute, you've been professing this strategy for years, decades, and you've been talking about this, but yet nobody seems to have been able to achieve the results that you have. And his comment was, because nobody's willing to give it the time that I have. And so one of the things that is really hard is that it is one thing to find the, great company. It's another to hold it. And the challenge for most investors when they look at this is that volatility is a feature of individual stock investing. And that volatility, because you're getting a daily price point every, on daily, minute, second, on every basis, people feel like they need to respond to that. And that they think sometimes that the price is actually connoting, what is, happening with the business. And so the challenge for most people is to control their own emotion, to keep their temperament in check. And so you would ask on what are some of the things that kind of differentiated where I was looking and what, truly identified that. And a lot of it came down to, so what I did, just taking a step back, is I not only just used the numbers, but I actually went back and looked at all the newspaper articles, anything I could read on the company 2 years prior to their IPO and 1 year after. And so just trying to put myself in that position at that point in time to see what was really, that an investor could have had available to them. And it came down, to the what I call the 4 E's, and we talk about this in the book. It's a 4 E framework. And the first one on that was essentiality. And this concept of essentiality was, is the company so valuable to their customers that if they weren't there, either their customers would struggle mightily, or some of them might even fail if they didn't have them there. And so that was one of the most important parts, is that, is this company really mission critical to that to their customer? The second was the things that we had talked about in the that there's excellence in growth margins and returns. And this wasn't just kind of one off or a short period of time. This is over the long term. We're talking decades that they are able to do this. The third was enduring competitive power. Now, this is the one that plays in to ability to own it for the long term. Because you could be essential, you could have all the great things, but if you don't have a business that actually is truly unique and that is sustainable and enduring over the long term, it's going to be hard for you to continue to generate those returns and deliver on that growth. But the last one is the one that probably played into the most. It's entrepreneurial missionary management teams. And the reason why this is so important is that we talk about volatility of stock prices, and that is always going to be the case. As you well know, Mike, the stock market itself, the overall index, 500 companies in it, still actually has an average of a 14% drawdown every single year on average. Well, individual stocks are even more than that. They're probably more in the 25 to 35% range. So over a 30-year time frame, you're going to have a lot of volatility in the stock price, but there's also different points in time that the companies actually went through a perceived or even a real existential threat. And it was how that management team responded to it that really made the difference. And so as I go through and we walk through the different steps of what makes that potential next 100 bagger is you first eliminate all of the, bad businesses, things that are over levered, things that, are in declining businesses, things that are, low return, all the different aspects. Then you layer on top of it that 4E framework to actually then screen those further down, and then you start to have a universe of companies that potentially could live up to that 100 bagger status for the long term.
How do you manage your entry point then? And do you go full position on day one? Do you put out 250K and because there are going to be entry points where we'll follow stocks for a long time, and they're good companies but not great investments yet. And then you get the market overreacts the wrong way, and you get your chance because as you know that what the price you pay is a big part of what your long term return ends up being. So how do you manage that timing?
Yeah, and it's a very good point. So I'm going to answer in two ways. First one is that through the 100 bagger study, it actually showed that on average, there's about 2 to 3 companies that would come public every year and actually eventually went on to become 100 baggers. So what that tells me is that universe continues to be, a fertile place to look. Now, the second one might surprise you a little bit is that in a shorter time frame, valuation's extremely important for your returns. But over the long term, and we're talking 30 years, valuation actually played a very de minimis role in that return. And I was actually very happy to hear that, and primarily because one of my great heroes, Charlie Munger, used to say the return of a stock over the long term is determined more by the return on its business than the price that you pay over time. So an 18% return on capital business over a long enough time frame should generally deliver an 18% type of stock return. Whereas a 6% would be, a much lower towards that 6%. But to your point, one of the reasons why valuation is such an important part on the short term is that because most businesses don't actually change dramatically in the short term. And this goes directly to what we were referring to before as the compounding effect. So a 15% growth in 1 year, say it's on $100,000 is, you're getting your 15%, from a company building that. But when you get out to year 15, you're now, if you're compounding that, you're now 10 times bigger. So it actually plays into that year in and year out. And so valuation, if you pay a little bit too high in the short term, but over the long term, the business is compounding, it doesn't have nearly as big of an effect on it as you might guess.
I'd like to add an observation on compounding here, something I really deeply started to understand in the course of writing The Coffee Can Investor. When you look at Matt's charts on, these companies compounding 16.6% a year for 30 years, they're doubling every 5 years. And the power of doubling, I mean, Albert Einstein talked about compounding being the eighth wonder of the world. And I'm like, if Albert Einstein is saying that, I need to really understand this. And So I'm looking at these charts of his, and the curves are kind of just like bumping along for years. And then they start to exponentially take off. And I think normal people have a hard time understanding exponential phenomenon as opposed to linear ones.
Yeah, because Buffett
And
made most of his money after he turned 60, right?
exactly. And I include this story about the guy who founded chess in India. And the king in India at the time invites the founder to come play with him. And he just says, "Look, I love this game so much, I want to reward you." And the guy who invented the game says, "Okay, just give me a grain of rice and double it for every square on this chessboard." And the king says, "Yeah, sure," probably in Hindi. And so, we attached a dollar value to a grain of rice and started to compound it, and it takes a while for it to even add up to a penny, and then soon a dollar. And then at some point on the chessboard, the rice grains are worth more than the combined net worth of Warren Buffett and Elon Musk combined. And by the end is more than the entire United States GDP. And so that patient investing, that compounding over time was important to me to really telegraph and explain to long-term investors.
Yeah. Seems to be a theme on the show this month. I had Ben Carlson on about a week ago now. It'll be 2 weeks ago from when the time this goes live. From the co-host of Animal Spirits, and he's written a book recently as well, and he touches on this a lot as well. He has a character in his book called Bob, who just he times his entry in the market at the worst possible time in every market crash, and just ahead of every market crash. And he ended up having just a fine return in the end of the day. He turned his, I forget what the numbers were, but 25,000 to $1 million or something. And, he did okay, even if you beat yourself up of being the worst investor of all time, then you're still going to be fine. So on the topic of IPOs, I can't resist. It was June 4th today. We're recording this. Is going to drop on the 15th, so apologies in advance. It's going to be 4 days after the SpaceX IPO. Any hot takes for us?
I think all of these things speak to the power of AI, and nobody knows where this is going. But we all know this is a transformational moment. We don't know if the initial companies are going to be the winners, like we saw in the dot-com boom. And we know that they're going to have a huge impact on companies everywhere, including, some of the picks inside the coffee can. And, during the sort of interviews with Matt along the way, the topic of AI came up a bunch. And what are the moats that you need to have in some of these companies to survive, let alone thrive in this new era? So, we talk about that a lot, and I'm excited to see what happens with these companies. And, as an owner of a Tesla, I will reveal who I'm rooting for.
And I would actually just add to it too. I think you never underestimate Elon Musk for driving transformational change. I mean, the guy not only is brilliant, but he has figured out how to really push change on things that, we never really thought would happen. I mean, he is the CEO and owner of, I think somebody told me like 7 or 8 ongoing billion-dollar plus companies. Obviously, several of them are, going to be now trillion-dollar type things. But his philosophy and his focus is, undeniable. Now, we could argue, and I think Morningstar has come out with a, piece just recently saying the valuation is, extreme, if you will. But to Neeraj's point, I'm excited to see kind of what happens and where this goes, because we live in unprecedented times today where I think for the motivated, the driven, and the, intellectually curious, there's going to be some great massive transitions that are going to happen. And I know some are concerned about what AI brings. I'm actually on the other side thinking I think 10, 20 years from now, there's going to be a lot of things that have been solved that we never thought could have been solved, just 5, 10 years ago.
And, just another observation of the kinds of companies that Matt has been focusing on. As much as things are changing, you know, Mark Twain said that history rhymes. And, when you think about some of the companies that were really interesting in his original 100-bagger study, he mentioned Fastenal making nuts and bolts. One of the companies he chose to put into the coffee can is a company called Diploma out of the UK. And, it's kind of like that scene in the movie Cocktail where, he kind of looks at the plastic tip around his shoelace, Tom Cruise's character, and says, I want to make that. Well, one of the companies, in terms of history rhyming that Matt chose, Diploma, makes like those rubber seals and gaskets, that go between machine parts. History rhymes. You look back at the original 100-bagger study, one of the companies that Matt focused on, he mentioned was Cintas. And, they deliver, these uniforms. Fast forward as much as things change, you know, he focused in on a pest control company called Rent-A-Kill that is using the same model, delivering services by vans to different businesses. They're not cleaning uniforms, but they're, providing pest control services and expanding market by market and acquiring within markets and then driving margins up. So I think as much as technology changes, a lot of the models, the business models that really worked in the past, again, one man's picks, but I'm seeing it repeat through new companies moving forward.
And interestingly, the examples you gave there are all fairly insulated from the impact of AI as well. Old
Exactly.
economy.
Exactly.
All right. Well, fellas, we're just coming to the end of our time here, unfortunately. For each episode, I ask my guest or guests a two-part question. So I'll ask if you could both respond to this one. This would be great. So what was your first job? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
So my first job was that I kept score at a, men's softball league. I was 12 years old. I was working till 10:30 at night. I'm surprised my parents would let me stay out that late, but it was in the small town of Beloit, which Neeraj so eloquently explained in the book. Um, but I've been working since I've been 12, almost continuously, and so to me, work is always something that provides purpose in life and provides an opportunity for you kind of to express your own kind of value add. And so the second question on what advice I'd give to myself, if I can give kind of two part to this one, I would say stay curious, continue to learn, be be open minded to kind of what the world has to offer and where you go. And then the second part to that, I would say, be patient. We all want things to happen immediately. We love to actually have, our stock you buy it and it immediately goes up. But, the reality is the best things in life oftentimes take time. And the other part on that is kind of be kind to yourself too, because mistakes actually happen. And some of the mistakes that you make, and we talk a lot about my mistakes in the book, are the ones that provide the greatest learning experience that actually propels you to the next level. So if you can learn from those, but kind of be kind to yourself to just know that that's part of your ongoing journey in life.
So I'll reciprocate. My first job was working for the late Peter Jennings when he was an anchor at ABC News, and that was an incredible experience. Doing primetime specials on, the war in Yugoslavia, the Haitian refugee crisis, and so on and so on. And the advice I would have given myself back at that time would have been don't focus so much on how stories are being delivered, the medium, and focus on just the stories. And to say, that, since Beowulf, people have been paying for copper for a story, and that would always continue. And now we're doing this story with you, Mike, via Zoom on a podcast, and in multiple locations. And it's all about great stories. And if I can just add one last thing, Mike, just to bring it back to where you began, this story was done for our kids. And, when I look at trading patterns of the average hold time of a stock being 5.5 months and declining, it was really important to both of us to make sure our children understood long-term investing and not just trading. The average retirement is between $300,000 and $400,000, and the importance of investing in yourself and into your retirement and for your kids. And I think what both of us discovered as we were doing this, and the book ends with Matt talking to his kids about what he and his wife are doing for them. Their reactions are just priceless. They never once thought about the term inheritance, and really just wanted to keep learning. They started talking about their favorite stocks with Matt, over the Thanksgiving table. And so for both of us, it was a voyage of discovery to learn about our own kids and what they needed and wanted. And most of all was they just wanted our love along the way, and support. So, as we are around Father's Day, I just wanted to underline what was most important. And I would have told my young self, have kids sooner than later.
I've been speaking today with Neeraj Khemlani, former president of CBS News, and I should add, a senior leader across an impressive array of journalism broadcasters and publishers outside of CBS, and also the author of The Coffee Can Investor, A Stock Picker's Journey to Build Generational Wealth, published this past April. I've also had the pleasure of hosting Matt Ankrum, CFA, managing partner of Ankrum Capital, the inspiration and source for the insights in this very excellent read. Thanks, fellas. It's been really great having you.
Thanks, Mike.
Thank you, Mike.
I'm Mike Wallberg, and this has been The Enterprising Investor.